So, Yahoo was a lot of fun, right? I mean, what a story. Who doesn't love a good bubble? Everybody's dancing. But, it's not fun when that bubble pops. Because now it's 2003. And Yahoo and many internet companies like it have gone from darlings in the eyes of investors to completely untouchable. Every VC firm, not only public investors, even every VC firm was significantly underwater in their investments. The vast majority of them lost money for their LPs. I mean, today it's bad if a venture capital firm returns, less than twice the money they got from their LPs, let alone lose money for LPs. That was kind of a death sentence back then, but today especially is a death sentence. I mean, that never happens. So it's crazy that that happened to basically every investor during that time. And Sequoia is extremely proud to have eked out a measly 1.3x on their fund that fought through this disastrous period for tech investors. I mean, Doug Leone is on record of saying it's one of the proudest moments in Sequoia history, which, as we've talked about so many of the highs, and as we'll talk about the more highs, I mean, this is the lowest of the low point, and that just emphasizes how hard it was to even return a 1.3x on that fund during this time. And so one company that we're going to talk about now that was hugely responsible for that scrappy 1.3x was LinkedIn. And LinkedIn couldn't have been started at both a worse and better time. So let me explain that contradictory statement. So obviously, it couldn't be much of a worse time to start a tech company because all VCs were licking their wounds from what they just went through, trying to even keep the lights on to keep their jobs, let alone invest in speculative startups. I mean, many VC firms could not raise future funds as interest in the venture capital space itself completely fell off a cliff. I mean, VC firms raised $104 billion in 2000 and only $9 billion in 2002. Huge difference. I mean, 90% less money in 2 years later in 2002 than there were in 2000. So obviously, there's a lot less money to be spread across new companies. And many investors who are even still willing to invest at this time are going to be looking to mitigate as much risk as possible on their investment. Now, luckily for Reid Hoffman, the founder of LinkedIn, the internet doesn't stop. Public markets, private markets, investors, financiers might be slowing down, might be stopping, might be grinding to a halt, but the internet is not. I mean, user adoption is still growing exponentially, and more people are becoming more obsessed with exploring the web every day. So many people started spending time online that social networks began popping up. Friendster, launched in 2003, amassed over 4 million users in its first year, which even today is a huge number, let alone in 2003 when a small fraction of people were using the internet compared to how many use it today. So it was clear that social networks were going to be a thing. The internet was going to keep growing. Social networks were going to be a huge thing on the internet. That was becoming apparent. Even though this is 2003, and even though everyone is scared out of their minds, by looking at the potentially massive social networking market, and based on the resume of Reid Hoffman, who was an early VP at PayPal that just had a huge $1.5 billion exit to eBay in 2002, LinkedIn seemed like an investment that might be worth the risk after all. As Don Valentine once said, quote, "We are in the business of making investments. We're not in the business of not making investments." I mean, in the VC space, it's pretty easy to say no to every single company. There is not a zero risk company you can invest in, especially at the early stage. At the later stages, there's a lot less risk. But again, we're talking about early stage investments. There is always risk. So you can say no to every single company. It's probably going to be a lot easier to say no than it is to say yes. because there's so many risks companies at the early stages face, especially at a time where the entire market, the entire tech market, internet market is recovering from the worst experience that many VCs have ever seen with the pop of the tech bubble. But it's important as a venture capitalist to maintain the mindset of what could go right if you invest. What are the traits these founders have that make them compelling? Does the market they're going after have the potential to grow? Do their early users love the product? If these questions are all yes, or at least some of them are a strong yes, then the macro factors don't really matter. I mean, a startup at the early stages is just focused on their first 1,000 customers. They're not worried about all these crazy macro factors affecting millions of people. They just care about their first 1,000 users who love the product. Those users are going to find that product, love the product, no matter what the stock market is saying at the time. That's irrelevant for these companies at the very early stages. So, back to LinkedIn. To get an idea of what the company was like at the time Sequoia invested, because again, we're putting ourselves in the shoes of these investors, it's really important to understand what that company was like rather than think about LinkedIn today, which is like, obviously LinkedIn's incredible. But back then, it was a pretty measly social network. And so after Sequoia invested in 2003, LinkedIn posted on their website to announce the Series A. And they put some stats in there that I thought were interesting. So here's from that press release in 2003, right after Sequoia invested. LinkedIn wrote, quote, "Over 20,000 hiring managers have already signed up for LinkedIn. The referral system ensures that they can only be approached by candidates who come recommended by someone they already know and trust. Due to this powerful pre-screening from trusted professionals, LinkedIn users only receive requests of high value to them. In fact, LinkedIn users accept over 76% of all referred contact requests, which is 20 to 50 times higher than the acceptance rate of email requests that arrive without a referral from a trusted source. Since LinkedIn is already facilitating over 1,000 successful referrals per month and is doubling in size every 6 weeks, the additional funding will be used primarily to accelerate the development of additional tools that will provide even greater utility to professionals in all industries and across the globe. In just 6 months, LinkedIn has spread far from its Silicon Valley roots, already gaining users in over 80 countries and 120 industries." I mean, after reading that, I hope, you're also starting to think like, yeah, I would totally invest in this company. I mean, it's doubling in size every 6 weeks. Crazy. Already in 80 countries and 120 industries in its first year of launching. Already have over 20,000 hiring managers who absolutely love the product. They have data that referrals on LinkedIn are much more successful than any other place for hiring managers. And so based on that, PR announcement, there are two insights I want to talk about here. Again, bringing up principles of Sequoia that are stated by later partners because, it wasn't cool to be public as a venture capital firm until the last 15 years or so, which I would say is because of the birth of Andreessen Horowitz, which we'll talk about later, but because of them being so open about marketing and talking their book in 2009 when they started to differentiate themselves. Really interesting story there. It wasn't really until 2009 that VCs started to talk about their strategies and their theses, which in turn certainly attract founders and serve as a beacon of, hey, here's what we're looking for. You should come talk to us if you meet these, requirements or align with these principles or ideas. I mean, that's what I'm talking about today, but that was not common back before 2009, basically. So a lot of these quotes and theses and principles that we talk about were stated after 2009. But again, the DNA of Sequoia has been there for a long time. So even though these are stated past 2003, for example, when they made the LinkedIn investment, it's safe to assume that these thoughts were still percolating in the investors at the time. So the first one we're going to talk about is, again, from Jim Getz, partner who we referenced before. And he talks about focusing less on the total addressable market, the TAM, otherwise known as, and more focus on the actual customer. Now, he says, quote, "We regularly see entrepreneurs come in and talk about billion-dollar markets, its large TAMs, and that's just not as interesting to us as the passion that comes from trying to solve a very specific pain point for a very specific customer." Now, I'm going to talk about this in a second, but I'm going to jump ahead to another quote that I think relates right to this point by current Sequoia partner Jess Lee. She talks about targeting a niche of underserved users and how that is a huge success factor for startups and is something VCs really look for. She says, quote, "There are underserved customers everywhere. You have to be a little contrarian to make money investing. You have to either see opportunities other people don't or opportunities other people underestimate. You have to be willing to take a risk on things that maybe haven't worked before. And I just saw firsthand as a female founder and working on a product targeting women first that, hey, there are big businesses out there that people don't think are big businesses. And those underserved customers, if they are served, become wildly, deliriously happy. And then you get a community and this incredible moat of community that leads to word of mouth growth." So let's unpack these two quotes. First, from Jim Getz. Any founder can come into a meeting with this beautiful, glorious slide that says our market is $100 billion. You could find a way to make that number as high as possible. And it looks great, and it's good that you're targeting such a big market, but that's just not very interesting. I mean, anyone can do that. So why are you unique? I mean, in every meeting, that founder has to have something that makes that VC think, I haven't seen that before, or that's a unique insight I've never heard before. You have to stand out some way. So rather than just having this big TAM, on your screen, which you should have, but I think it's important to kind of tell a story about your TAM, about your total addressable market. Rather than just saying our market is $100 billion, you can say our market is this customer, Tom, who is a hiring manager in China, does not have a lot of resources, does not know how to get great referrals. He's starting his own recruiting firm or something. And you can just talk about how he uses this product every day. He's gotten all of his referrals from LinkedIn. He loves it so much. He has told many of his friends about it. He's left us great comments about it. And because we think there are a million, whatever I said his name was, Tom, Mark, John, whoever he is, because there's a million of those out there in the world, we think our TAM can be $100 billion. So by talking about the market in that way, by talking about that one specific customer, and then talking about how there are many of those that make up your large TAM, that's a lot more compelling of a story. That'll get the VC to be like, okay, this person really knows their customer, and I can see that there are a lot of customers out there in the world. And if that one customer loves this product so much and it's transforming their lives so much, yeah, there likely are a lot more people out there. So I can see why this market is so big. And as I said, I used this example of a hiring manager in China because to get users that really love your product, really love your service, this brings us to the quote I said from Jess Lee about how there are underserved customers everywhere. There are a lot of people out there that maybe are dying for a better service or really looking for a better way to do their tasks, but they don't even know where to look. So if you can expose your product or your service to that person and you finally solve this problem they've been having for years, they will be deliriously happy. They will love your product. They will tell all their friends about it who are likely in a similar position to them, or else, their friends would have helped them find the solution. So if you can find that customer, if your product is so innovative and you have such a great insight that you know the people who are struggling with this problem and you know what their problem is, and you can solve that problem for them in the most perfect way, they are going to become obsessed with your product and they will tell their whole network about your product, especially if you're a social network company that has network effects, as in where the site gets better as the network grows. I mean, the word of mouth and the virtuous loop there of marketing from community-driven marketing just becomes incredible. So the lessons here are just hone in on your individual customer, know that individual customer very well, have that story of this one customer in your pitch, and then use that to arrive at your TAM, because there are a lot of Johns out there in the world who love LinkedIn and need to use LinkedIn. They just have to find it because they are so underserved by everything in the market today that they will absolutely love your product. So to go back to LinkedIn, LinkedIn was going into the world of social networking, right, which was becoming huge. Everyone knew that. But rather than taking on companies like Friendster, like many social networks are doing, just as a place to go and talk to one another, they went after a niche group of hiring managers. They knew that this was an underserved community that had very minimal online presence up to this point, and an online presence that wasn't addressing their needs, wasn't solving their problems as well as it could have. They knew that there would be a massive community online if LinkedIn was very methodical with their delivery of their product and ensured it stayed a high value product for its high value users. Again, focusing on value creation rather than value capture, building the simplest and easiest to use product, and just addressing those underserved customers' needs as well as you possibly can to make them just obsessed with the product. LinkedIn was fantastic in all of these regards. So it was a great investment. And LinkedIn was building a product for a niche market of underserved customers that was growing, exponentially. Not just the exponential growth of the internet, but just more and more people becoming online and more opportunities arriving online for something so valuable like hiring managers to hire candidates and get referrals and just find more people rather than just in their immediate network. So again, 2003, a lot of VCs were on the sidelines, but I'd suspect a lot of VCs saw what we just talked about, and LinkedIn, checking all those boxes, great venture investment. So again, how did Sequoia win the deal? Sure, they had the reputation, but what else did they do? So first, Sequoia was an early investor in Elon Musk's X.com back in 1999 before its merger with PayPal. So once X.com merged with PayPal, Mike Moritz, who was on the board of X.com, joined the board of PayPal. And so Moritz and the Sequoia team knew Reid Hoffman well, and they knew the potential he has as a founder, and they already had that relationship that had been building for years prior to when LinkedIn was created. So there's already a relationship there, which is valuable because I'd assume Reid Hoffman went to Sequoia early on, and I'm sure Sequoia was very happy to take the meeting and engage in LinkedIn with Reid Hoffman. Additionally, Sequoia wasn't as damaged as other VC firms because they were early investors in Google, which by this time in 2003 was basically primed for a large IPO in the near future. I mean, the IPO would come in 2004 on my birthday, fun fact. But in 2003, I mean, you can tell, when this company is going to be big, like it's going to be valuable. By 2003, people already knew that. It had a huge IPO in 2004. So a year earlier, this was already $1 billion company. People knew that. So that win, that they were already feeling in 2003, like they knew they were going to get some good returns from that. That gave them a little more of a risk appetite than other investors may have been feeling at this time. And I know I mentioned Google, and I know I mentioned how great investment it was, but I'm not going to talk about Google in this Sequoia episode. I will talk about Google in the future Kleiner Perkins episode, which is going to be really cool. Mini trailer. We'll talk about Google, talk about Amazon. Incredible investments, incredible stories around that. So stay tuned for that sometime in the future. Anyway, so essentially, wins lead to more wins in venture capital. Much like Atari eventually leading to Apple, since Sequoia invested in PayPal and had built that relationship, with Hoffman and with other PayPal engineers who had joined LinkedIn, they had that relationship and that unique insight into how great of a founder and operator Reid Hoffman could be. And so that's one aspect of wins leading to more wins. And then the second aspect, they had the confidence from the Google investment, and they had a little higher of a risk appetite, a little more leash to go after unproven niches, such as a professional social network and employers for job candidates.